Hello, and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the absolutely glorious Pacific Northwest. We are live on Facebook. Welcome, everyone. I hope you all are doing well. I hope everyone's staying safe, staying healthy, staying sane in a very, very, very troubling and insane world. And I hope you guys, whoever is out there that is listening, I hope that you are praying for the safety and health and well-being of all of our friends, our countrymen, our colleagues, our families. It's a very scary time indeed. I wanted to jump in real quick, and I don't even know where to begin. There's so much going on. It's just an amazing time. But I did say that there are some things going on in condo lending, and I want to talk about that. It's important. It is important. Let me just take a moment here to collect myself and say that things go on, life goes on. We have to continue with what we're doing here in the US and here in the Pacific Northwest and in the real estate industry and in the mortgage field and all these other things, even though our minds might be elsewhere and our prayers are definitely elsewhere. So I'm going to tell you what I can about these new rules that Fannie Mae and Freddie Mac has adopted for condo lending. And it's a big deal because it doesn't matter if you work with me, which you should. In fact, I highly, highly, highly recommend it. But I understand that not everybody does, and I get that. But if you work with me or one of my colleagues or one of my rivals, or if you go to your bank or you go to your credit union or an independent mortgage banker like myself, it's irrelevant where you go for lending on a condo, because at the end of the day, 90%, if not more, maybe 80% of all these loans go to Fannie Mae and Freddie Mac anyway. And what I mean by that is, as I've explained to you in the past, when we do a loan, there's two parts of that loan that are happening after the closing. Forget about the good part where the client gets the keys to the house. Our real estate partners get their commission for selling the property, and we get paid, and the clients move in and everything's moving down the road. That's the easy part. That's the great part. But there's a lot of stuff that happens behind the scenes. And there's two components to financing after the fact. Number one is the servicing. The servicing is basically, who does the client pay every month for their mortgage payment? I was going to say, who does the client write the check to? But very few of us, myself included, still write checks. Every so often I include a check, but for the most part, it's all done electronically. In any event, the servicer is the institution or the company to whom the homeowner now writes their payment every month. I was about to say writes their check, to whom the homeowner makes their payment every month. And so for us at New American Funding, most of our loans, 97 or 98% of the loans we originate are serviced by us. So if you do work with me and I close your loan for you, 97, 98% of the time, you're going to make your payment as a homeowner every month to New American Funding, which is awesome, because if there's something that goes sideways, if you get something in the mail that you're not sure about, if you get something, that it's just a weird sort of thing, you can always call me and say, hey, what's this all about? Or if you want to pay down your balance and reduce your payments or do whatever, you could always call me. I don't personally work in the servicing department, but New American Funding is a family, and I could definitely help internally to get you to the right place and to make sure that you're taken care of. So servicing is one component, but the second component is, who does the note go to? Remember, when we do a loan, we create what's known as a securitized instrument. It is a financial instrument. It's an IOU, for lack of a better description, and that IOU has some financial value to it. And my company, New American Funding, as well as every other company just about out there, takes that IOU and sells it, usually to Fannie Mae and Freddie Mac. They buy about 80% of the paper or the loans or the financial instruments, the IOUs, that we originate in this country. So whether you work with me, which like I said, you should, or you work with somebody else, at the end of the day, we're all going to be impacted by these rules that Fannie Mae and Freddie Mac have already put in place regarding condos specifically. So what's the background on this and what are the rules? Okay, so background first. When we used to do loans for condos, and when we do all loans, by the way, for Fannie Mae and Freddie Mac specifically, there is something called desktop underwriting. It's an automated underwriting service. Think about it like AI for the mortgage. So when I have your loan application and it's all electronic, back in the day when I started 20 plus years ago, we'd handwrite these things, right? But since that time, everything went electronic. The loan application's electronic, it's linked to an electronic credit report. All of these things communicate in the background. It's really kind of cool when you think about it. But when we are ready to submit the loan for initial underwriting, we send it through Fannie Mae's desktop underwriter or Freddie Mac's loan prospector. These are both automated underwriting services, and they look at, through AI, they look at the loan application file and the credit report and other things. And they will dictate to us what we need to collect from the client, from the home buyer, in order to make this transaction sellable to Fannie Mae and Freddie Mac. When I say sellable, remember, we want to take that IOU, bundle it up, and sell it with a bunch of other IOUs to Fannie Mae and Freddie Mac. In order for them to buy it, their automated underwriting services has to, first of all, come back with a determination that based on all the information that we've input into the loan application, based on the client's credit report and credit scores and credit profile, this loan would be sellable. But in order to complete the deal, now physical underwriters, human beings, actually have to look at the paperwork, document the assets, document the income, make sure that what was put in the loan application is actually accurate, because anyone can put anything in a loan application. An underwriter needs to make sure that it's accurate. So when we did that back in the day, depending on how much down payment was being brought to the table by the buyer, what sort of property occupancy, whether it was going to be owner occupied or a second home or an investment property or something of that nature, a bunch of different factors would dictate through the automated underwriting system what Fannie Mae or Freddie Mac wanted from us as the loan originators to collect on the collateral, on the property itself. Now, the collateral has a variety of different things that we deal with. The appraisal is part of the collateral package. The title insurance is part of the collateral package. And when we deal with condos, the homeowners association is also part of the umbrella that overlooks the collateral. And so back in the day, the computer, I hate to say it, but the computer would tell us, you can get by with a limited condo review or a full condo review. And the system made that determination. Now, having done this for more than 20 years, I know that there are certain things that would lead the system to go in one direction or another. Down payment was a big one. If you had 10% down or more, typically the system would say, hey, a limited condo review is all we need. Since that time, and in the last month, Fannie Mae and Freddie Mac have kind of changed the rules. And now we are dealing with and approaching every condo project, every condo loan, I should say, as a full condo review, because Fannie and Freddie want more information about the collateral. Why do they want more information about the collateral? Two big things. Number one, about a year and a half ago, 2 years ago, in South Florida, there was a high-rise condo. It was already built. It was already occupied. I don't recall exactly how old it was, but it was a high-rise condo that collapsed. It was a terrible loss of life, terrible loss of property values. It was a disaster. It's hard to use that word right now with in light of everything that's going on in the world, but it was a really big problem. And I think that part of this had to do with that. I personally think, reading between the lines, reading between the lines there you go. I would think that there's something else going on as well, which is maybe Fannie Mae and Freddie Mac are concerned that homeowners may have a hard time making their mortgage payments in the coming months and years based on what's going on with the economy, based on what's going on with rates, based on what's going on with inflation, based on the Federal Reserve just saying outright that they want to see higher rates of unemployment. I think Fannie Mae and Freddie Mac may be a little bit concerned that people are going to start defaulting on their mortgages a little bit more than they have been. And I think that Fannie and Freddie, because they hold the note and therefore they are securitized by the collateral, want to make sure that whatever they're buying is collateralized with properties that don't have excessive deferred maintenance. And so I personally think that there's something to that as well. But regardless of what I think, what Fannie and Freddie now want is a much deeper review of the condo association to make sure that when we do a loan for someone who wants to buy a condo, the association is strong enough to maintain the property to a certain level. And so three main things have changed in what Fannie and Freddie are looking at, and what will or will not make it possible to do a condo purchase or a condo refi. And this is whether you work with me, which, like I said, you should, or whether you work with any other lender out there, your bank, your credit union, some other competitor of mine. Here's change number one. Any structural or mechanical work that's been accomplished in the last 3 years needs to be underwritten by us on behalf of Fannie Mae and Freddie Mac. Because remember, we're underwriting to their standards, not our own standards. We don't have what we call in the industry overlays, meaning that like Fannie requires this much information, but we're going to add that much more on top of it. We are a direct lender to Fannie Mae and Freddie Mac, meaning that whatever they ask for, that's what we ask for, not any less and not any more. And a lot of other lenders are like that as well. So Fannie and Freddie say, if it happened within the last 3 years that there was any structural or mechanical work, we want that underwritten. So what does that look like? And let me ask you this question. How would they know, right? I mean, I think a lot of people out there, because I've been talking to a lot of real estate partners out there, and you know, one of the questions is, well, how would they know, right? I mean, who's to say what happened, and who's to say when it happened, and who's to say any of these things? Well, there's a few things. Number one, if you have and this is specifically for Washington State, so guys in Texas and in Florida and Kansas and wherever else you might be watching me from, this may or may not apply specifically to your states, but I'm willing to wager that there's something pretty close in there. But in Washington State specifically, if the condo association handles at least $75,000 a year in association dues, then they are required every year, I believe it's every 3 years, to do what's known as a reserve study. A reserve study is basically a third-party company that goes in there and starts detailing what needs to be worked on, what has been worked on, what hasn't been worked on, what systems are going to fail and when, like what their lifespan is. Hey, you got a 30-year roof and it's been 15 years since you put it on, or something like that. What's going on with the elevators if you have a high-rise condo? What's going on with the parking structure if you have underground parking? What's going on with the boilers and the chillers and the mechanicals in the building? Remember, condos, basically, it's a lot of people living together in one building envelope, and internally they have their own little space. So if you have a large enough association, there's got to be a reserve study every 3 years. And guess what? Now we're going to have to take a look at that. And so if there's been any work done in the last 3 years that's structural or mechanical, we're going to find out about it. And so we might as well get a head start on figuring out what's going on. So what is mechanical and what is structural work? As I mentioned, elevators, boilers, electrical, chillers, things of that nature for sure. If you're dealing with large roof issues, if you're dealing with exterior issues like siding and things like that, that might be an issue. If you're dealing with decks, there's been some problems in the Pacific Northwest with decking and things of that nature. Those things are structural issues or mechanical issues. And again, if you've got a large project, we're going to find out about it. Now, someone asked me, well, what happens if we got a small project? Like, it's a 12-unit condo or a 20-unit condo, and we don't have $75,000 a year worth of HOA dues coming through the association. That may very well be the case. But one of the things that we always ask for when we deal with condos is something known as the condo questionnaire. And the condo questionnaire is like a 5 or 6 page form that needs to be filled out. Most of it is a yes or no checkbox sort of question. But at the very bottom of that, some person needs to sign that. That person is taking liability for basically providing accurate or inaccurate information. And so there's no fudging on this, or at least there shouldn't be any fudging on this. Now, in some cases, condos, smaller ones especially, the associations are managed by one of the residents or a couple of the residents, right? They don't have professional associations that do nothing but manage the condos. They've got, the owner of unit number 101 is the president, and the unit 202 is the vice president or whatever it is. And they handle all that stuff, and they have real jobs on the side. They have real life on the side. This is not what they do 24/7. This is just kind of what they're doing. And so they would have to sign off on that. And if it turns out that they signed off either erroneously because of they were deliberately wrong or they were just mistakenly wrong, they're still liable. So I think that even if you've got a small condo, at some point, someone's going to put their neck out and sign that paperwork for the lender. And I would imagine that those people would be relatively eager to stay on the right side of things, because at the end of the day, if you lie on a loan application or you lie on loan documentation, somewhere in there, that's a crime. And I think it's a relatively serious one. So that's change number one. Any mechanical or structural work that's been done in the last 3 years, we need to know about it, and Fannie Mae wants to underwrite that. So that's one change. That's a big change. Change number two, any project that has a cost of at least $10,000 per unit that's not yet funded, Fannie Mae and Freddie Mac want to know about that. So there's a lot of projects that happen where they're doing like a special assessment, right? Where you look at the minutes of the condo association meetings, you look at the notes, you look at these other things, and you see that they're gearing up for, or they're talking about doing a special assessment, extra costs per unit for work that needs to be done. Maybe they want to redo the roof, or they want to resurface the parking lot, or whatever it is. They need to collect more money than they already have in the dues that they've got in order to do that work. If that work is $10,000 per door or more, and there's not enough money, it's unfunded at the moment, Fannie Mae and Freddie Mac are going to take a really long look at that. Now, how do you fund these things, right? One of the things that has happened in the past, and this is especially available for larger associations, is that they borrow the money for the work. So, they say, well, hey, we've got a $2 million project that's coming that we're going to have to fund. And it's going to be $20,000 a door. Let's say they've got 100 units in there. And so $20,000 a door, they're going to have a special assessment, but they need to do the work right now. They need to get started on the work. So they take a loan as an association to do the work, and then they bill the residents. Okay. Or the owners, I should say. That's not unfunded. That work is funded. But now there's going to be a special assessment. So to the loan originators, what we have to go back and say is, well, the dues are $500 a month, let's say. But because of this special assessment and because of this loan that's been taken out in order to do this additional work, the dues are going to jump to $1,000 a month or $800 or whatever the thing is. So we're going to have to underwrite the buyer on their ability to repay the mortgage based on the higher dues, not the current dues. And so this opens up a lot of questions. This opens up a lot of work that we need to do in advance, a lot of detective work, quite frankly, to make sure that the buyers that we're doing loans for on condos are going to be able to afford the acquisition price and the monthly payments, but also like future potential deferred maintenance or assessments that have been discussed that just haven't really been done yet, or that haven't been funded yet. So that's rule number 2 that's changing. Rule number 3 is Fannie Mae maintains a list, and I took a look at it yesterday on behalf of one of my referral partners. It's what I refer to as the no-go list. These are condo projects, and it's nationwide. Condo projects that are so far gone that Fannie and Freddie don't even want to mess with them. Like, seriously, if you're on this list, I don't know how you get off the list. There's a whole section of information on any one of these projects that they've already detailed, like, this is why this building or this project is on the list. And they've got like a litany of things that have created issues, that have created problems, that have been untreated. So you keep in mind that the association, think of the condo building as your home, as your single family home, right? Like, I own this home that you see behind me here and all around me. I love this place, and I do the best I can to maintain it, right? So when things go sideways, and they do sometimes, they have to be repaired, they have to be replaced, they have to be managed. Sometimes I pay for all that out of my own pocket, right? I mean, I've got insurance on the house, of course, and other things, but like, if I needed something, siding or painting or a roofing or plumbing or electrical or whatever it is, I'm not going to call my homeowner's insurance for stuff like that. It's my personal expense, and I have to take care of that, or not. And the same thing with condos. They have to pay for it through the association, through their dues, through all of the tenants, or I'm sorry, tenants, all the owners that have an equal ownership in the outside of that building, or the mechanicals of that building, or whatever it is. But not all associations are very good about that. In fact, some of them kick the can down the road. Some of them are not well managed. Some of them, it's not the management's fault, it's the ownership of the units themselves. They don't pay their dues on time, or there's a ton of deferred maintenance, or a ton of other things going on. And so people just basically kick the can down the road a little bit, and what was a small fix after a few years of neglect becomes a big problem. And in some of these cases, like, the cities have gotten involved and they've red tagged these buildings. In some cases, Fannie and Freddie have just gotten to the point where they're like, absolutely not. We're not buying loans collateralized by properties in these projects. So once you're on the naughty list, so to speak, I think you're pretty much done by way of any financing. You can always get a cash buyer, right? You can always get a hard money loan, or a what we call non-qualified mortgage loan, which is a more expensive loan, right? There's going to be higher interest rates, higher than where we are already, which is really high, or it might be a larger down payment or something else. So there's always an option, there's always a will, but one would have to ask, like, why would you want to live in a place where you can't finance it? Because the person you want to sell it to 5 years, 10 years, 20 years down the road, they may not have any options whatsoever. And so that third change is, if it's on the no-go list, it's on the no-go list. And so Fannie and Freddie won't touch it. Now, there's a few additional things that I want to talk about with regard to condos, but basically the catch is, or the key is, that first and foremost, we want those associations. And when I say we, I'm talking about Fannie Mae and Freddie Mac, and by extension, us, the loan originators, and by even further extension, the homeowners, or the people that are thinking about buying in these projects. We want you guys to work within the reserve study to make sure that you are budgeting for things and planning for things in the right way. And I know that stinks on ice. I get it. It's expensive and so on and so forth, but that reserve study is there for a reason. In fact, I own a piece of property. It's a small piece of ground. It's like 5,000 square feet. There's nothing on it yet. It's just land, but it's in a community east of the mountains, east of the Cascade Mountains, in central Washington. It's going to be a lovely, lovely community. There's only 5 homes built thus far. There's, I don't know, about another 100 and some odd lots that are going to be built up and whatnot. But there's roads, and there's a community center and there, a pool and things like that. And we're already talking about the reserve study. For heaven's sakes, we don't even have I don't even have any place to stay there. I mean, I could go pitch a tent on my lot, but we had an association meeting yesterday talking about how much do we have in reserve, what is the reserve study and whatnot. So Fannie and Freddie and the lenders by extension would say, hey, the reserve study is there for a reason, and any association that is very diligent should be working on dealing with these things and preparing for these things in advance. And if they do that, and if they stay on schedule, then it's going to eliminate most of the problems that you can imagine. The things that Fannie and Freddie are really trying to overcome are issues of health and issues of safety. So I remember, let me look at my time. Good, we've got about 5 minutes left. I remember when I started in this field, gosh, 2001, it feels like a lifetime ago. But there were a lot of condo conversions at the time, meaning that these were apartment buildings that someone bought and decided to condominiumize them and to turn them into units for sale. And in the course of doing that, they had to separate out a lot of the plumbing and a lot of the electrical and a lot of these other things. There was also new condo construction and whatnot. And there were all sorts of really shoddy builders out there, really shoddy developers who made mistakes, big mistakes. I remember one friend, his name is Steven, I'll leave it at that, but he had on one of the walls, just like water just coming all the way down. Like there was like this green moss and mold growing on it, like it was just coming from one of the units above him. And clearly you could not loan money on that. It's a health and safety issue. You send the appraiser in there, he's going to see, or she's going to see that right away and say, that's got to be dealt with. And so a lot of these homeowners associations 20 years ago or so sued the developers and sued the builders to come in there and fix their construction defects. That hasn't been the case as much of late, especially on new construction. But as things get older, myself included, as we get older, things don't operate the same way. You know, what wasn't a problem 5 years ago for me now suddenly is like, that's interesting. And the same thing can be said about buildings, about cars, about condos, about everything else. And so Fannie and Freddie have made these changes. The changes are in place. So there's no getting around them now. The best thing we could do is communicate, real estate partners. Look, I've got a huge database. I've got an entire condo department at New American Funding. We've got a list of condos that are already approved. Even if you're not working with me, which I think you should be, but even if you're not, let me be a resource for you. Call me up, send me an email, tell me what you're working on. If you're taking a listing, you should know if that condo is going to be financeable. If you're working with buyers, you should know if that condo is going to be financeable. So use me as a resource or as a lender, ideally, but let's talk and make sure that we've got enough lead time before you guys get into trouble, because it's taking as much as 45 days now to close these transactions, where because we want to make sure that everything is dialed in for Fannie and Freddie. Now, in the past, we've closed deals as fast as 15 calendar days, and we still do that. But when we're dealing with condos now, there's a lot more work that needs to be done, especially if it's a smaller condo that's managed by one of the residents there, one of the owners there, and they happen to be on vacation or whatever else is going on in their world. So suddenly it becomes really challenging to get paperwork or to get the condo questionnaire, things like that. I did hear that a lot of the big banks, by the way, are taking as long as 60 days to get their arms around condo financing, because nobody, my company, the bank down the street, the credit union, none of us wants to be held or left with a loan that is not sellable to Fannie Mae or Freddie Mac. What that does basically, let me see my time. Yep. What that does is it limits our liquidity, right? So I have this IOU for $500,000. I want to sell it to Fannie Mae and Freddie Mac, get my $500,000 back so I could loan it to the next buyer and the buyer after that. If the loan is not sellable, that's $500,000 less in this example that my company does not have available to us to loan to the next buyer to buy their home. So big changes are here. Change is a constant. And what I urge you guys, if you are thinking about buying a condo, if you're thinking about selling a condo, if you're a real estate partner and you're thinking about representing someone's listing for a condo, or you've got clients looking at condos, please call me. You know where to find me. You know how to get a hold of me. Let me help you figure out what's going on. Until then, and until next time, I want to thank you guys for spending a little bit of time with me. Please check in with me. The world is changing as we speak. Interest rates are going higher and higher. We'll talk about that next week, unless something else comes in and intrudes on my schedule of what I want to talk with you guys about. But until then, if you happen to be in the Pacific Northwest, that sunshine over there, we're not going to have it for very much longer. It's like 70 degrees outside and it's late October. It's wonderful outside. So get outside, get some fresh air, get a change of scenery, get a little bit of sunshine, and enjoy your weekend. I will see you guys next week. Until then, please stay healthy, stay safe, and stay sane. And thank you so much for spending a little time with me. Y'all take care.